everybody. Welcome to Friday, another Talk Money with Tom show. Really excited today to be able to try to help you improve your retirement. Ask us questions. This is how the show works. You send those questions in to Ask Tom at talkmoneywithtom.com. Anytime during the week, during the show here, you can send them in. You can also put the questions into the chat. We'll answer your questions live. Looking forward to that. We always cover questions that kind of came up during some of our client reviews also. So, really our big push is to try to help people understand more about the financial aspects of retirement. We created this channel. We cover retirement planning, tax planning, investment management. Those are the three big categories, that we feel it really isn't represented enough, in the school systems and what have you, that's for sure. And so you can go on the channel, you can subscribe to the channel, hit the little notification if you want to get notified when we put new content on, and we'd be happy to try to help you along here. We have over 1,200 different videos on there now, and we're continuing to create new content. So the last thing, of course, sometimes people, don't want to ask a question on a show. They want to just ask us, on a one-on-one basis. And so we provide that also, of course. You can set up an appointment with us. You go to our website. There's a book appointment button, looks just like this up in the corner. Set up a 30-minute, in-office video, phone, time to meet with Ethan and I, and we'll, be able to answer your questions directly. So all of these are there to try to help you, improve your situation and have a more enjoyable retirement. Whether you're already retired or, looking forward to retirement at some point in the future, a lot of these concepts still apply to either group. Okay, so of course I always like to start off the week with a summary of what I saw happening with the stock market and for the week. And really it was a decent week so far. It looks like we're finally going to have an up week. We've had 3 down weeks in a row.
Bumpy one.
Yeah, and we've been talking about, actually right near the top there, we started talking about the fact that we felt the market was going to need some type of a pullback, a consolidation period, rest. Because we had such a giant run from, really the early part of May. Mm-hmm. Ironically, when Silicon Valley Bank went out of business, that was the beginning of the run. Not what you'd expect, right? And it is one of the key things to think about. I'll bring this up again. Understand the power of what the government can do, right? Mm-hmm. In how that might affect the stock market. So when Lehman Brothers was allowed to fail in 2008, the stock market dropped 30%, after that. And this time, instead of allowing the banks to, fail and depositors to lose money, which would have caused probably another Lehman event, government stood up and said, hey, we're going to backstop the depositors, and all of these different programs are put into place. So very important to understand it. It sort of fits in with, a lot of talk over the last couple of weeks since we did our last show about China, mm-hmm. right? And so it kind of fits in that same category. And so today, China came out with some more stimulus programs and reduction of transaction costs on stocks and those types of things. And it's still probably not enough. They've got some issues, but they're the second largest economy. At this point in time, we have to assume that they could do enough at some point in time. And so again, that's why I tend to discount some of those things a little bit. The biggest thing I really want to bring home today has to do with the fact that if you're hearing something, and it's lots of articles are out there and what have you, the stock market has already factored that in. And oftentimes the market goes the opposite direction when that actual thing happens. So for example, this week we had earnings from NVIDIA, and boy, there was so much talk about the earnings and how great they could be. Markets going up, NVIDIA stock went up even on Monday before the announcement. And because the last time that they had an announcement for the first quarter was spectacular, mm-hmm. it caught the market by surprise. I think NVIDIA went up, roughly 40% in a few-day period there. This time, nothing, right? Even though the earnings were spectacular. Again, everybody's expecting something to happen and the market to jump and NVIDIA to jump. It's not going to happen. That's a saying that you can say to yourself. If I'm reading about this and it's the debt ceiling situation was something we were getting a lot of questions about. It turned out to be, a scary scenario, but the market, I think, had a high and low drop of about 3%, which is actually more than it's dropped even now in this particular downturn, about 5%. So I think those are some core components of investing that we need to understand, and maybe thinking about the other way. What are we not talking about? I remember very little was said about credit default swaps in the 2008 downturn, and they turned out to be the news, right? And the surprise. And so those are the types of things actually that I tend to focus on even more, those one-off articles like I remember in 2008 about credit default swaps, which were, for those of you who don't know, were insurance policies that were issued on bonds that were made up of mortgages, right? And they were selling them like hotcakes. Apparently they sold like $7 trillion worth of these in a very quick period of time, thinking there's no way that these bonds with 1,000 mortgages and it could default. Well, unfortunately they did, and the mortgages that these bonds had to pay off, these insurance policies had to pay off, and et cetera. And then Lehman was one of the pieces of that and the house of cards that fell. And so these are things that, that are out there that we don't know about. We're all talking about China, right?
Yep.
And the market's factoring that in. Now, sometimes I'm wrong in what I'm talking about, and it happens, and China falls apart, and but we were all talking about the Ukraine situation being a big disaster for the stock market. It didn't tend to be. We all said that the oil and gas, lots of articles about how high that was going to go, maybe 200, 260 a barrel. It actually went down. It's coming back now a bit, but it really, things tend to go the opposite direction of what you're hearing about the most. That's the point. And man, 9 out of 10 times, as far as that goes. So here we are. We're having this consolidation period, and again, I've got some, some lines drawn in here, kind of where you might see some motion, and we're in this range, and really what I'm looking at when I see something like this is this a consolidation period, or is it the beginning of a full-on downturn? And one of the reasons you have to kind of let things run for a while is because of that. Because look, I think that if I look at kind of what I'm really concerned with are these resistance levels right here. So see that first green line, that actually is the top for last summer, August 16th of last summer. It took us a bit to get through that and what have you. I would be somewhat concerned if we broke through that. Not wildly concerned. I'd actually be more concerned with that second line there. If you go back, 3950 on the S&P 500 was a really heavy period of time that a lot was purchased at that level. You can see some good support and resistance at that level. And so, the thought process with resistance is that it gets down to that price. So it gets back down to 3950. And those stocks that people made money on, in the last few months, I got back down there, I'm going to buy some, right? And so they buy, and usually you get that bounce, and then it comes back up. But if they don't buy enough and it falls through, then it becomes, it goes from support. I've been using the wrong word, from support to resistance. And so that's the kind of the key piece here. We're just going sideways until you start to break into new lows that are lower than previous lows. Because, we have an intact upward trend right now. Primary trend is up. Each one of these highs is higher than the previous high. That's important. And each one of these lows is higher than the previous low, right? So that's intact. We break below that 3950, you can make an argument that we no longer have an intact, primary upward trend. And there's still a bunch of people predicting that we're going to have these big downturns. These are the same people that were predicting the giant recession in the first half of this year and all those things too. And again, I think that classical Wall Street view is that we should be falling. Yeah.
Yep.
And because we've raised rates so much, but that's not really happening. Let's talk about the signals, because we had some changes today in the signals. So first of all, the stock signal went to green today, actually on the fast signal, still yellow on the slow. And so we have two different systems that we use. When the stock market is moving upward, and we define that as the 50-day moving average is above the 200-day moving average, then we are basically just holding on to the positions we have until they fall below a certain level on our list. So we got a list of 175 ETFs in our universe, and we optimize where that cutoff is. Right now it's top 55, right? And so when it gets below the 55th, 56th, we might sell it. and buy something at the top, right? And so we've been buy and hold for quite a while here on our targets. We haven't had anything really fall out. Mostly it's been technology that's been running here.
CapTech has been running.
Yeah, it's still going. It's still working. And so, I don't know where it's going to go. I don't know where the next big jumps are going to come, but they'll start popping up into that list and the top of that list, and you can see things, as they're developing. And so, even though we were at red, we don't make wholesale changes until the market's going down. And then when we're below the 50-day moving average is below the 200-day moving average, we get a red signal. We'll move, all the targets out and move into the whatever's at the top, which generally will be something more conservative.
Yeah, something defensive.
Yeah, T-bills, high dividend paying stocks, utilities, those types of things tend to be at the top in those environments. So we're trying to protect assets at that point in time. So what we were doing last year, right? So two different systems, and we've, from our back testing, we found that this is the optimal way to go. And we've had a really great run, in my opinion, on the stock market side of our equation since early May, and pretty happy with that. So now that we also had a change in the bond market signals, and so bond market is now green. It was red, now it's green. And so slowly but surely we're starting to see some stability in the bond market, and really this has a lot to do with what's happening with inflation, what the Federal Reserve is saying, and those types of things. And so what's fascinating is that if you look at the projections, so if we go here, this is the tool, the CME group does this Fed Watch tool, and this is the futures market. And so Jay Powell today was speaking from Jackson Hole. Again, market is expecting the possibility of a big drop. As a matter of fact, it dropped yesterday 1.35% on the S&P 500 in anticipation of today's speech. And lo and behold, you have the speech. Well, last year he had a speech, it was down 3%. It kicked off the downturn. And so again, expectation very high that maybe we'll have the same thing because he can be very aggressive. He doesn't have to take questions during this period, during the speech. And so, there's no way to really soften it or clarify. He can just boom, boom, boom. And we did see some changes. So this was at almost 90% probability that we would have no rate increase in the next meeting in September. And now it's dropped down to 80%. So it's still high probability that there's no rate increase in September. However, if we just go and we look at November now, November, again, we're missing a month here. They only do 10 meetings a year, so we're seeing those gaps here. But they've got a rate increase of a quarter point, barely. It's what, 46% versus 42. But that just changed today, based on this conversation that the Fed chairman had. So, if you look then past that, you can go all the way out, to I think next December in terms of the projections on the futures markets. It's actually predicting rate cuts next year. Right. Mm-hmm. And that's a good thing for bonds. And so, again, the markets are looking forward. They're forward-looking mechanisms. The S&P 500 is part of the leading economic indicator basket. There's only 10 indicators in there. It's one of them. The markets are looking forward. So when rates start to come down, what's that usually mean?
Rates come down, bond prices go up.
Yeah. And what's usually happening economically?
Probably falling into a recession or some sort of slowdown.
Yeah, some kind of slowdown. Maybe a job market slowdown, because that's the Fed's other mandate, is to keep full employment, right? And so now, and a lot of people say, wow, we're in this recession and, the stock market's going to fall apart. Sometimes it depends, on what happens. But I've seen an awful lot of recessions where the market does very well, mainly because it's already looking forward to the next. We're in recession now. The next one is, a economic expansion.
Right? Yeah, and the slowdown for the U.S. economy could be just a decrease in job postings. It doesn't have to be a major unemployment wave.
Yeah, exactly. So far, Chairman Powell, goodness, back in March of last year when they first started raising rates, talked about he sees the possibility for a soft landing, the Goldilocks zone, whatever you want to call it, for the economy because the job market was so strong. And he's been dead on right, even in the face of his other economists. There's over 400 economists at the Fed. As a consensus, they were projecting, a pretty good sized recession here, this first half of this year. That didn't happen. Then they talked about the second half of this year, and now they've taken it off the table. If you look at the reports, but the chairman himself was talking about this possibility of a soft landing and what he saw, and he's been right so far. I mean, it's been, what, a year and a quarter since that started, so we'll see. And that's why just watch the stock market, right? If we go back and look at what was going on with the S&P 500, it bottomed out in October and climbed that wall of worry. And the stock market's been correct, right? The reports that are coming out, they're not spectacular, but they're pretty good, especially considering what was expected on the negative, right? And so, we're fully invested. However, we do have new money coming in all the time. And we're sitting on that new money right now. I'd like to see 2 up days in a row. That's always been a key for me. We haven't had that. So today's up, right? So far, at least, during the show here, before we got in the show, it was up almost 0.8% on the S&P 500. We'll see where it ends up. But nonetheless, we've got this situation where, Monday hopefully will be up, but we haven't had that so far. We'll get that up day, and then the next day's down. And so, we're in a period where people are taking some profits. That makes sense. I mean, some of these companies like NVIDIA have had unbelievable years. And even the NASDAQ QQQs, the NASDAQ 100 is up, a huge amount for half a year period. There's no way that these things continue in a normal market. And so I do think that the AI component of the market is still going to be a driver. You can see it at NVIDIA's report. Their earnings and revenues were fantastic. A little hard to invest in it because a lot of the companies are small. This reminds me a little bit of the dot-com surge back in '95, so 5 years before it really crested. And the big companies were running at first, the Cisco's, the Sun Microsystems, and the companies that were seen as, the internet providers, so to speak. Cisco wasn't a big company at that time per se, but, similar to NVIDIA in that it's a provider. And then eventually you ended up with bingo.com and, some of these crazy things.
The general stores and the gold rush, the ones that are giving out the tools for the miners, those are the ones that are running right now. Before the actual miners. Are the ones that strike it rich.
So I wouldn't be surprised to see that kind of unfold again, because this seems similar. There's a lot of hype about it. We've shown that cycle a few times, so this is the hype cycle. I think that can be a driver that can continue to drive us back to a new high on the S&P 500 at some point in time. So anyway, that's what's going on right now. That's what we see. Really, appreciate everybody, watching through the summary, and we'll put that out as a separate video also. So looking forward to being able to talk about this again next week. All right, let's talk about the next questions.
Do you expect a lot more rate hikes to tame inflation based on Powell's speech? He seemed pretty hawkish in it.
Yeah, well, keep in mind that they want to be hawkish. I don't know how coordinated it is or how, I have no idea. I'm not a conspiracy theorist, but there is a benefit to them, okay, to have the stock market not do as well.
Yeah.
That's a fact. There's even been a couple of the Fed presidents who've actually said that, they said, what was being thought out loud, but it doesn't get talked about too much. And so, and it makes sense, right? I mean, if you don't want people to spend like mad, then make them feel a little bit more poor, a little bit more nervous. You make the stock market do poorly, and the bond market do poorly for that matter. So, the being hawkish doesn't mean they're going to raise rates. And a matter of fact, he did talk a lot about data dependency, which just means that in Fed speak, that just means that they're going to be looking at, the data as it comes in and trying to determine, what to do at each meeting. They haven't decided in advance. They do have a dot plot that predicted 2 rate increases this year. We have had 1.
Yep.
And now we see the futures market has kind of jumped on that also. And we're looking at another one in November, according to the futures market, right?
Yeah.
But past that, the futures market is saying down, for next year. So we were getting, quarter point, 3/4 point increases really this time last year. So a quarter point for the rest of the year in November, maybe pausing in September. They paused, in June. Yeah, so this no problem for the markets, no problem as far as I'm concerned. I did see a chart today on mortgage rates. They're up there. 7.38%
Yeah.
was the average 30-year mortgage. That's bound to slow some things down. But I also saw a chart on new home sales, which is doing quite well. It can be a little bit misleading because sometimes higher mortgage rates drive people to go buy that house, before, it
Lock it
gets
in.
higher. Yeah. And so if people jump off the fence. So, we'll see how that plays out. The expectation again was that these higher rates would kind of really cause problems for the housing market. That didn't happen.
Yeah, demand never kind of outweighed the supply. The supply just kind of dried up.
Yeah, well, even at the same supply. So, I mean, let's just make up a number. If there, and this is kind of an interesting analogy. There's 10 houses for sale, and there's 100 people that want to buy the homes.
Yeah.
So, yeah, the rates come up, the demand drops, and now there's 30 people that want to buy those 10 homes. They're still going to sell, right? I mean, that's a huge drop in demand, but it was already so high in comparison to the supply. And there has been some dry up of supply because people locked in these really low rates, right? And don't really want to move if they have to get another mortgage someplace, and now they're going to get 7 instead of 2 or 2.5, 3.5,
Yeah.
whatever it was, right? Yeah. Anyway,
Yeah, it's interesting because like the U.S. only did a quarter, but like other countries like Turkey did 7.5%.
7.5%.
So like there's a little bit more
Wow.
extremes.
Yeah, I think what they're up to 25% on
Yeah.
their. We hit 19% back in 1980, I believe, or 81. But that's pretty incredible. That's just those is mind-boggling. Some of these other countries and what they have to deal with, with in terms of inflation, and the things that can happen are 7. That's because we're at 5.25 right now, right?
Yeah.
So they moved up more than 50% more than we have, all at once, in one meeting. Wow, that's a tough stock market.
Is it worth waiting to buy a home? I can afford it now, but rates are high compared to a couple of years ago.
Yeah. Okay, well, that's a good question. One thing that catches my attention there is you're saying you can afford to buy it, right? So if you can afford to buy a home, that's one nice thing about mortgages. You can get a mortgage at, let's say, 7.2%, right? And be disappointed. But if it goes to 10, you're happy. If assuming it's a fixed mortgage, and you're going to be okay there. You don't have to go get the 10. But if it drops back down, you can refinance and get that. So if you can afford a home, I'd actually be more concerned not so much as the mortgage rates, just what's the housing market looking like? Am I buying at a high point or not? And how long am I planning on staying there? Is this a place I'm hoping to sell in a couple of years? Then I got to be a lot more accurate on the timing. Or is this my forever home that I'm going to live at 20, 30 years? Then the timing isn't that critical, per se. A lot of people probably overspent on homes here in the 60s, that are now worth 10 times more, that kind of stuff. So as long as you've got that timeline, I built my home. I had an 8% loan at the time, which was kind of standard, mortgage at that time. And now I've refinanced it back down to 2.75, right? So, don't worry so much about that. Can you afford it? Does it make sense? How long are you going to live there? What is the market like that you're buying into, in terms of where it is? Is it really, really hot, or is it soft? That kind of stuff. What's been the history of the appreciation in that area? I wouldn't worry so much about the mortgage rates because that's something you can take care of if rates come down. I don't know if they'll ever come back down to a point where we can refinance it, those really low rates.
Yeah, but you could possibly get down to 4.
Oh, yeah.
Within 4, something like that. So.
Yeah, I could see that. Yeah, usually there's some kind of calamity that's happening that's causing that. This was a pandemic. We had 2008. There's something happening. And unfortunately, that's when people generally don't have the money to buy homes either because they've lost some of their resources because the stock market came down. But if you already have a home, you don't care. You're just going to refinance during those periods.
Yeah, you take advantage of those periods.
Yeah. So that I would buy the house. now, as long as I felt comfortable with, all the other parameters.
Yeah. What are you looking to see for a breakout of this consolidation period? Are you looking for specific things on the chart? You talked about 2 days of positive, or what are you looking for?
Yeah, let's take a look here real quick. We can share this. Okay, so what happens in a consolidation zone is you usually have a bounds, and it will bounce around off of those bounds up and down. And so what you really want to see is kind of that breakout. In this case, it's fairly straightforward. That breakout's going to be that top red line, right? Yep. I think 4,600 and something, whatever that was. Seeing a breakout above that, and usually in these consolidation periods, when you get a breakout, you can get a nice run out of that. Everybody was looking at last summer's peak as one of the kind of resistance places, and we finally broke through that this year, and we got a nice run right after that. And we were holding on to money, that we'd been accumulating for our most nervous new clients and putting them in at that point in time, right? And that worked out okay so far, but I'm actually more concerned probably, and again, just to reemphasize with, is this still a consolidation? Every time we're in these things, that's what I'm thinking about. The breakout to the upside, it's pretty easy to deal with. It's the breakout to the downside that I'm more concerned with. And so here's my, support lines if we break through those support lines, right? So last year's summer high and 39.50. That number came up a lot.
Yeah, we're closer to breaking down than breaking up.
Yeah, and I don't think we're going to break down, but it doesn't matter what I think. I always say that. The market doesn't care what I think, right? It doesn't. And so you just look at it, pay attention, see what happens, react. Don't try to predict, and everybody's making predictions, one way or another, and some people are making investments based on those predictions. That is not something that I recommend. I think you're better off, just kind of going with what's happening, because we started buying technology in early May. At the time, it's, we were dealing with the debt ceiling, and it seemed kind of crazy, honestly, but that's what was moving, and that's what was moving upward and doing, and it worked. So just pay attention to what's out there. So yeah, at the moment, as you said, we're closer to the bottom of that range than the top, so you want to be paying attention. And if we get a nice bounce out here, and honestly, for me, and I don't have numbers on this, but just a gut feel, whenever August has been soft, it seems like once the Labor Day holiday was over, we had some decent markets that came in at least the first part of September. And September historically is not a great month per se for return, but it has a lot to do, I think, with what has happened in the prior month. If August is very hot, then you might get some pullback as far as that goes. So there's a lot of people taking traditional vacations this year, and so there's a lot less interest in the stock market and, those type of things. And then people get back to work and back to school. Of course, school's starting so early now. It's crazy what's happening. There's no summer anymore. But anyway, that's a good question to ask as far as that goes, just to kind of understand, what's going on. I would like to see it break out of that 4,600 and I think at 4,660 I think was the top-ish, and see it break through there, because if we don't break down, which we don't seem to be at the moment, we're in this consolidation zone at the moment, I think we get to a new high here. That 4,800 and something isn't that far away, and I believe that this consolidation period is what's going to allow us to get to a new high. And it's necessary. This is needed. I'd rather have it go straight up every day. We'd have a lot more money, all of us. Easier. It would be, but that's not the way it works. And so sometimes it just has to take a break first. All right.
I plan to save money to set aside for taking care of my parents. Long-term care costs just keeps going up, and my parents, though they saved, I don't know if they saved enough.
Yeah. I remember this article talking about the sandwich generation, where you might have parents in long-term care and kids in college, right? And that has to do with, people waiting longer to have kids, essentially is what's happening, right? And yeah, it's an interesting question, because long-term care can be very expensive. Obviously, it depends on the resources that your parents have,
Hmm.
right? Everybody's got different situation there. Parents have plenty of money, and maybe that's not an issue. But the reason that somebody's asking this question probably revolves around the fact that maybe their parents don't have as much as they might need. Because long-term care costs, we have a lot of clients over the years that have been in some form of long-term care, either in the
Yeah.
home or in a facility, and the spectrum is quite long, actually. Different types of facilities, different types of care levels. But I've seen anything from 1,000 to 15,000 a month,
Hmm.
right? That's a good range. Again, also really depends on where you live, right?
Yeah.
That 15 would be more here. It might be half of that for the same level of care, say in some place. My in-laws are in Wichita, Kansas, and you know, cheaper there for this.
Hmm.
So it kind of depends on where you're at. But to answer the question, yeah, I don't see any problem with starting to save. I mean, you're going to save anyway. Hopefully, you're going to have some kind of emergency money that you're starting to build up and continuing to build up. And if you got to a point where that's excessive in your own mind, whatever that number is, then maybe you're investing some of that. That's okay too, with some of that long-term care money, because not everybody ends up in long-term care.
Yeah, and yeah, having an extra bit of money saved never hurt anybody. You can always, like, if you don't need it, you can always use it in your retirement too.
Exactly right. Now, there's nothing wrong with starting to save. I wouldn't put it so much just for long-term care. That's just that's one of the things on the list
Hmm.
that you would be saving, because I call it emergency money. That's kind of an emergency money scenario. Possible, hey, cars breaking down, losing a job, right? Something happening within the family, which would include long-term care, all of these things that you kind of have that buffer for, and continue to build that up. If I was considering really helping my parents with long-term care, I might make that buffer bigger than I
Hmm.
would normally make,
Yeah.
even in the banking system, just because it can be very, very expensive, and honestly, this is something I feel like we need to solve. This is a big problem. We see this within our business. If you don't have any money, that's okay,
Yeah.
to a certain degree. It's not great, but there are systems here in our state is Medi-Cal, right? That will take care of you. If you have lots of money, that's okay too. It's still pain. It's still a lot of money that disappears. But people can usually are self-insured in that
Yeah.
group, and they can do it without too much massive impact to the other spouse. But there's a group in there, I want to say it's like the 500,000 group or whatever, right?
It's kind of in that middle.
Yeah, where 15,000 a month will eat through that really quick. Even if you have Social Security and some pensions coming in and things like that, all of a sudden, the other spouse is usually the biggest risk. If it's a single person, and you're not damaging the other spouse's,
Retirement.
retirement and finances. So there's a group in there, and honestly, that's the group that should have long-term care insurance.
Yeah.
When we run an analysis, and that might be the better thing to be thinking about here, is talking to your parents about that possibility, at least looking into it.
Yeah. If they're still in that insurable age range, you should take advantage of it while you can.
Yeah, again, you got to analyze whether you need it, and then again, there's this group of people in this kind of zone of money and assets that need long-term care insurance. We have a client right now who has a spouse in long-term care situation, had long-term care insurance policy, bought it here, and they're using that, and it's been a really big saver, and they're kind of in that zone,
Hmm.
right? And so, again, that's you got 5 million or 10 million or whatever it is. You do the analysis and see what would happen if you had that kind of outflow going on for a period of time. And a lot of times it still works.
Yeah.
We do that. We have a portion of our financial plan. So what are you afraid of? And one of them is long-term care. And we can go in and say, okay, you go to long-term care, you spend 15,000 a month, you're in there for 5 years, you're XYZ age. What happens to your plan? It runs a Monte Carlo simulation and lets us know. And again, people with a lot of money, it usually still works quite well. But again, that might be the better thing to look at there too, or at least a thing to look at, which is just, the policy itself, for somebody. And if this is something you're interested in, come see us for an analysis on long-term care. We don't sell the policies anymore, but we can help you determine
if you need
whether
one.
somebody needs one. And it could be very useful, and it might be wise to take a look at that.
My 30-year mortgage extends into my retirement. I'm only 51 right now. Should I consider paying it down a little faster so it pays off when I retire, before I retire?
30-year mortgage, so 51?
Yeah.
Okay, so didn't say when they're going to retire. I guess we'll say 65, so 14 years.
Yeah.
Got quite a few options there. I will make one interesting comment. I've been doing this for 37 years. 20 years ago, a lot of people, most of my clients had no mortgage in retirement. There's a lot more people with mortgages in their retirement now. And it's not just because houses cost more. It's like a willingness to have leverage in the situation. So one of the things that I look at is kind of what happens to the overall outflow versus inflow situation. So I have a certain amount of money I have to put out in order to live in my retirement. Some of that is discretionary. I could eat out, or I could cook at home. I could travel internationally. I could take a car trip, right?
Yep.
Those are discretionary things I can cut back on. I have a mortgage, or I don't have a mortgage. I can't cut back. If things fall apart and I'm spending $3,000, whatever, just say it's $3,000 a month, I can't get rid of that $3,000 a month. And so then I have to look at the other side. What do I have coming in? So I have a lot of Social Security and pension, let's say in one scenario.
Yep.
More than enough to cover that $3,000 and all my basic expenses. We don't have a lot of clients in this category, but if you're in that category, holding on to that debt is probably okay.
Yeah,
right?
especially if you have a lower rate.
Yeah, especially if you have a lower rate. Exactly. And so on the other hand, let's take somebody who has Social Security but is getting a lot of their income off of the stock and bond market. So they've got this variable income coming in that is really being used to kind of pay this mortgage, right? And I can't get rid of that mortgage. And now I'm 75 years old. I can't get a job either because I've been out of the workforce for 10 years, that kind of thing. I would like to have that kind of fixed cost reduced as much as possible. If I'm going to be retired, I really wouldn't want to have that mortgage payment to pay, irregardless of so even if the rate is low. Some people say, oh, you keep it because the rate's low because I can make more money over here. Well, what happens if that over there doesn't work, right? And we end up in the next Great Depression or whatever might be happening. And now you've got this mortgage payment that you can't get rid of. And so I look at what I'd like to have in retirement is that, fixed amount of money that I have to spend is really, really low. Now I might spend a lot more than that, but it's discretionary. I get to decide. And if things are good, I spend more on things that I really like. And when things aren't, I cut back.
Yeah.
And so I have that flexibility. So the mortgage payment reduces that flexibility, irregardless. And again, unless you have a lot of Social Security and pension to cover all of that fixed cost, so it's sort of like fixed incomes, covering fixed costs, right? That's good, but most people don't. And so we're relying upon the stock and bond market, which is inherently unstable.
Yeah, but if you're willing to take on more risk, you could have a better possibility if you were to invest that money and then pay a lump sum at your retirement, in theory, because with 14 years, on average, the market is up in those 14 years periods.
Yeah.
And so you could get more money in your long term by doing that.
I think there was only one 10-year period where the market was down, ending in 2009. So 14-year period, probability is that you would have made money, right? Yeah. And most likely even made more money than the cost of the mortgage itself. So you take that extra amount of money that you were going to put in your mortgage for the next 14 years, you put it into the S&P 500 or whatever. There is some risk there, just in the sense that you get to retirement, all of a sudden the Lehman Brothers situation happens and the market's falling apart, and now you can't get rid of the mortgage. Maybe you split the difference. Yeah.
Yeah, you could split the difference.
Right. Part of it just goes into extra payment. Part of it goes into this,
investing.
Investing. I like that.
Yeah.
Yeah, and so it does make a difference as to what the rate is. So
Yeah.
if I got like me, I have a 2 3/4 point, mortgage right now. Um, you know, I could probably beat that over a
Yeah, I'd
14-year
feel a lot
period.
easier
Yeah.
being that than like a 5 or 6%
Well, it's
mortgage.
7.2 right now, so I got 7.2% mortgage. I'm gonna wonder about the S&P's ability to make
Yeah,
sure, because I don't know how many years out of say 100 out of 100 years that the S&P 500 made more than over a 14-year period made more than 7.2%.
yeah, paying off debt's kind of a guarantee of a
Yeah,
return.
yeah, exactly. So no, it's a great question. We get asked that type of thing quite often. I'm a pretty big believer in trying to have no debt entering retirement, and I am seeing that happen less often.
Yeah, I think because mortgage rates have been quite low for a few, like a decade,
Right.
people are more inclined to keep it
Yeah.
than
Yeah.
previous decades.
Yeah. I just from my own personal preference and working with this for the last 37 years, just understand that even if you have a 2 3/4% rate, it is still a guaranteed outflow that you must make. You have to take a look at what you're getting your inflows from.
Yeah.
Where are they coming from? So I would look at pension, Social Security as being fairly secure. So that would offset that fixed outflow. That's great. So analyze those. I would look at rent as kind of being in that next level, pretty secure in most places, but not as secure as say Social Security, but secure. And then I look at the stock and bond market being at that next level of kind of unusual returns. We show that big chart at the beginning of the show.
Yeah.
It's not a straight line by any stretch of imagination. So having said that, when we do plans and we take the stock and bond market out and we say, hey, we just put all this money in the bank, they almost all fail. So we actually need the stock and bond market, to work over the long term, and it has. So anyway, that's a pretty interesting question altogether. I would personally, I guess from this whole conversation, I might split the difference. If I had an extra 1,000 a month that I could use, I thought would pay off. I'm making up a number, but I thought would pay off that mortgage by the time I got to my retirement. I might put 500 into the mortgage and 500 into something like the S&P 500, which I like. It's simple, it's cheap. And then at the end of the time, hopefully I have more than enough to pay off the mortgage with a lump sum. And boom, I go into my retirement, and maybe I have some left over in that
Yeah,
S&P 500.
if you can grab a CD for a 10-year that
Right.
outpays your mortgage,
Right.
maybe that's a way you can
Yeah,
go. Then you're
yeah.
guaranteed in a sense.
Problem is, it's usually it would assume that then you have a lump sum now
Yeah.
to pay it, and oftentimes when people are looking at that, because that's a totally different question. I have enough money right now to pay off my mortgage
Yeah.
versus should I pay it off over time?
Yeah, that's true.
It is different scenario. So if it's 500 a month, dollar cost averaging is awesome into something like variable like the S&P 500, and that can help you too. So anyway, it's a good question. I prefer to not have that debt personally. That's been my advice with my clients for quite a while.
Yeah, and sometimes you don't have to be financially optimal to actually have a good situation.
Yep. All right, that's our show for today. I really appreciate everybody joining us. Really enjoy doing these shows. We will be here. We've missed quite a few Fridays this summer. A lot of things going on, trips and what have you, but we'll be here next Friday. We'll continue to be here for a while anyway, and look forward to seeing you then. And again, feel free to send in those questions anytime that you want, and give us some chance to look at them. We'll come up with some nice graphics, all kinds of things to answer those as well as we can. You send them into the email address here on the screen. You can subscribe to our channel if you want to continue to learn more. You hit the little bell, get notified when we put out new content. And of course, you can set up an appointment with Ethan and I, and we'll answer your questions, one-on-one. And be able to help you out there. So look forward to seeing you next Friday, and thank you for joining us today.